Hello friends, welcome to learning sessions and good evening to all of you, and this is the second class for the CIB, and we have already been covering the module B, and module B is the most important module if you're preparing for the CIB. I've already told you guys that if you go for module B and module A completely, definitely you can score 50 plus marks in the upcoming CIB BFM exam. And in this particular series we are going to cover four compulsory papers of the CIB. We will be covering the BFM, ABFM, ABM and the BRBN. So make sure to subscribe to the channel right now, and if you still are having any doubt, do let me know in the comment sections. I'm going to post the videos 5 days a week and these are going to be very much important. And if you are a premium user, you'll be getting the access to the PDF files. Also you'll be getting the access to the case study videos, you'll be getting the access to the chapter wise previous questions, mock test, everything that is going to be covered. So previously in the video we covered about some of the topics related to the chapter 1, that was related to the basic risk management. So we covered about what is risk, what is risk management, how the organization hierarchy works over there, and moreover we covered about the different parts of the risk management, and further we covered at how it is being done. Like I told you very clearly that in the case of the risk management, first of all it's related to risk identification, then we do quantify the risk, then the risk pricing is being done, monitoring is being done, and further we can do the mitigation part. But further I also told you, whenever we try to mitigate the risk, definitely somehow we also do lose the potential, positive potential. Let's take the case that if I want to safeguard my car from getting lost, or let's say if I want to basically get the insurance cover, for that particular case I'm also to pay the premium, and when I'll be going to pay the premium, definitely there is some cost that has occurred to me, right? In the same scenario, let's take the case that the ABC bank is there, that is going to give a loan exposure amounting rupees 10 crore to XYZ company, right? But now ABC bank is in doubt that further it may happen that due to any of the defaults or due to any of the instances, it may be the case that the amount will be defaulted by person XYZ or XYZ company over here. Now in that scenario, ABC bank, which is going to be the protection buyer, will be going to the protection seller and is going to buy the protection that in any of the events, CDS, that will be credit default swap will be done, that if there is any default in that scenario, the loss will be made good by the protection seller, right? For that particular scenario, the ABC is to pay a premium to the protection seller. So ABC is a protection buyer and PS is a protection seller, and the bank is to pay some amount as a premium to the protection seller so as to get some protection. So let's say previously the bank was making 1.10 crore as a revenue from that particular 10 crore loan, but now as of the premium is to pay, let's say 10 lakh premium is paid, in that scenario the bank will be earning only 1 crore. Now the positive potential is also reduced whenever we try to reduce the negative potential or downside potential, right? So we covered about it, the risk identification, the major risk categories we covered a case study even, right? So if you are going to clear the CIB, if you're having a resolution so that you want to clear the CIB in the first attempt, this is going to be a very good opportunity for you, right? And now let's move further. We are going to cover the three categories of the risk management. Now what are the three categories of the risk management? First one, it's related to, we are having the sensitivity based, and identification can be done on sensitivity based. Second one, it's related to the based on the volatility, and further the third, quantitative measure where the risk can be classified, it is the based on downside potential. So first of all, we are going to cover the sensitivity, that is the sensitivity measure. So sensitivity actually does what? Sensitivity captures a deviation of a target variable due to unit movement of a single market parameter. As I told you previously also, there are multiple parameters which do affect the movement of the particular loan amount, or let's say we can say the underlying exposure whatsoever you're having depends upon a number of parameters. And let's say the case I'm just taking one single parameter, I'm not considering any other parameter, and I'm going to do the unit movement of this particular parameter, and then I'm going to check the changes in my exposure. That is what, that is a sensitivity. Let's take the case that I'll be looking into the factor of the interest rate only, that when one unit movement of the interest rate is being changed, right, in that particular scenario, what is going to happen, how it is going to react, that is what, that is a sensitivity, right? So that is the case related to it. But sensitivity is having its limitation. One limitation I already told you, because in case of sensitivity you do go check only one single parameter, you don't go and check multiple parameters. And in real life practical scenario there is multiple role play, that the multiple parameters do act simultaneously. So this is a very big you can say drawback related to the sensitivity. And moreover, sensitivities do depend upon the prevailing conditions, and definitely they are going to change as the market environment is going to change. So it's not going to help you. It's just for the, let's say we can say book purposes, that you can say that if 1% interest rate is changed, then what's going to happen, how much change there will be in the underlying particular exposure over there. That's the sensitivity. And after that, the second quantitative measure is the volatility. Now volatility is basically related to the stability or instability of the random variable. Let's say the case that we are having a random variable R, right? So whensoever we are going to change something, right, or let's say case we are measuring the particular exposure at different instances, it's basically having the different values. Now this random variable is changing the values like R1, R2, R3, R4, and up to Rn it is changing the values. Now at the different time instances it is having the different values, right? And let's say case I found the average of this random variable R. Now what will be the average? It will be the sum of all the terms, that is R1, R2 plus R3 and up to Rn over here, and divided by the number of terms. Let's basically denote this average by the letter Ra. Now what's going to happen actually, that if we draw a particular graph related to it, and here comes the Ra. So average will be lying somewhere here, and the different points will be lying, some points will be on the left side and some points will be on the right side of the average. So we can say that some of the points might be favorable and the sum of the points might not be favorable, right? That may be the condition. And when I'll be drawing a graph related to it, you will be getting a bell type structure. This is called distribution. This is called what? This is called the distribution. And if the graph is symmetrical around the curve, it is said to be the normal distribution. Right now I'm not concerned about if the distribution is normal or not normal. I'm just telling you one thing, that we are going for one single random variable and we are checking its value around the particular different point of times. And if we basically have a common statistical measure, then it will be showcasing some dispersion around the average value. So Ra over here is representing the average value, and these particular points are showcasing the dispersion because these values are somewhat different. Let's say case the average was 800. Now the some values might be below 800 and some values might be above 800. And when I drew the graph, it is coming somewhat like the bell type structure. This is what this is related to the dispersion. Now this random variable could be earning, it could be related to market values, it could be related to the losses due to default, it could be anything, right? So volatility is telling you about the changes, it is telling you about the certainty and the uncertainty, and volatility is none other than the standard deviation. So we can simply be saying that when we are talking about the volatility, it means we are going to talk about the standard deviation. Is that clear so far? So standard deviation tells you about the changes, it tells you about the thing. And in the last particular video I told you very clearly that the volatility is a standard deviation, and more is the volatility showcases more is the risk there, more is a inherent risk to it, right? That's the main thing. And what do you mean by standard deviation? Standard deviation is the under root of the variance. So standard deviation is none other than under root of the variance, and we can easily be calculating the standard deviation. The formula is quite simple. Like in this particular scenario, if I tell you we are having the average as RA, and I'm having the different terms like R1, R2, R3 up to Rn. So if I am to calculate the standard deviation, how can I be easily be calculating? It's the sum differences from the average mean, right? So it will be R1 minus R bar square of the same plus R2 minus R bar and square of the same, and so on up to Rn minus R bar or Ra square of the same, right? And divided by the number of terms. This is the formula. Let me just tell you the point over here. This is the formula related to the variance. So this is related to variance, and when I'll be finding the under root of the same, it will be the standard deviation. We'll also be solving the standard deviation, so don't worry, you'll get to know that how we can be solving the standard deviation so far. Is that clear? Kindly please do let me know. Kindly confirm the same, right? So that's the first point related to it. And volatility calculation is having a simple formula over the time horizon. So if we are to calculate the volatility over the time horizon, it is daily volatility multiplied by under root of the time, or under root of the time horizon. We'll be solving a case study based upon it in the next video. We will be solving a case study based upon the volatility in the next video. Don't worry about the same. Now let's have a look at this particular question. So we are having the different particular zones, or different 5 zones, A, B, C, D, E. These are 5 different zones here, and for the different years we are having the different operating profits. Like in year for A we are having 11, 9, 3, 12, 11. And when we are going to find the average, this is mean is showcasing average, right? So average is having the formula related to what? That sum of the all the terms, that is 11 plus 9 plus 3 plus 12 plus 11 divided by number of years, that is 5. So it is 9.2. 9.2. This is the average. And how we can be calculating the standard deviation? How we can calculate the standard deviation? For first zone, let me just calculate the standard deviation for you so that you can understand the point, right? So first of all, we are having the average with us. It is 9.2. So the formula goes like, standard deviation is having the formula like x minus x bar square of the same divided by number of terms, and that's it. This is the formula. Now how we are going to calculate? The first term over here is 11. So 11 minus 9.2 and square of the same plus 9 minus 9.2 and square of the same. Because it is square, no term will be negative, right? Other one, it is 3 minus 9.2 and square of the same plus 12 minus 9.2 and square of the same plus 11 minus 9.2 and square of the same. These are the 5 terms, and divided by number of terms, that is 5, and under root of it. So this is what we need to solve. Very much easier, don't worry. So it is 11 minus 9.2 and it is 1.8 multiplied by 1.8. So it is 3.24. The first term will be 3.24 plus 9 minus 9.2, that is 0.2. 0.2 multiplied by 0.2, that is 0.04. So it is 0.04. The next one is 3 minus 9.2, or 9.2 minus 3, that is equivalent to 6.2 multiplied by 6.2, that is 38.44. 38.44. Next one is 12 minus 9.2, that is equal to 2.8 multiplied by 2.8, that is 7.84. The last term is same as that of the first term, that is 3.24. 3.24 and divided by the number of terms, that is 5, and under root of it. So we will be adding up all the terms. So it will be 3.24 plus 0.04 plus 38.44 plus 7.84 plus 3.24 and divided by 5 and under root of the same, that is 3.24. So it is 3.2496. This is the standard deviation. This is a standard deviation. And let me just tell you one more point. Whenever we are going to check one single particular zone or one particular, let's say, industry or something, then we are to find the standard deviation. We can be telling you that which one is more volatile or which one is carrying more risk, right? But when we are talking about the multiple zones and we are to compare them, inter comparison is to be done. In that scenario, we are to calculate the last particular term. Last term is to be calculated. In that scenario, last term is to be calculated. So it will be 3.2496 divided by 9.2, that is equal to 0.35. So we have to calculate standard deviation to mean ratio. Standard deviation here we calculated 3.2496 divided by the mean, that is 9.2, and it came out to be 0.35 over here. Right? So for all the zones, we calculated the same way. We calculated the mean, we calculated the standard deviation, we calculated the standard deviation to mean. So in the question, they can simply be asking you, like in the case study type question, it can be given to you that you're just provided with the number of years and the zones over here, and you have to calculate the means yourself, you have to calculate the standard deviation, and you have to calculate the standard deviation to mean. It won't take you much time if you are practicing over it, right? So just make sure that you're having the simple calculator with you whenever we are online, when we are live, when we are solving it, and whenever you are studying, you must be having the simple calculator along with you, right? So you can check that we are having the different values. Here we are having 0.35, 0.63, and so on. Now, in what particular case you are having the least value? In which case you are having the least value? In the case of zone A, we are having the least value. Least value showcases what? That the least volatility is there. And whenever least volatility is there, it means the least risk will be involved in that scenario. The least risk will be involved in that particular scenario. Is that clear? Is this clear so far? Kindly please confirm. So we are having the least risk in case of which zone? It is the zone A. It is a zone A where we are having the least risk, and we are having the maximum risk in case of which zone? We are having the maximum risk in case of zone B. Maximum risk we can say in case of zone B. Now, the interesting point is that is the role of diversification. Now, what do you mean by diversification? Let's take the case that you have invested the money in equity. I'm just giving an example here. Let's take the case that you have invested the money in equity and your ROI is, let's say, 13%. But definitely it will be carrying much more risk. Now you are investing some amount in the SIP. You're investing some amount in FDRs. You're investing some amount in mutual funds. Right? Now, different instruments will be carrying different risks. Some of them will be having the higher risk and some of them may be having the lower risk. Let's say case ROI we are considering for SIP. Let's consider ROI is 10%, FDR it is 6%, mutual fund it is 8%, and that's the case, right? Now, what will be the average? Average would be definitely be lesser than the higher one. Now, if you have to calculate the average, it will be 13 in plus 10 plus 6 plus 8 divided by 4. That is 9.25. So in this scenario, you are earning an average ROI of 9.25%. So this is what I'm trying to tell you is that whenever we do diversify our portfolio, the overall risks can be reduced. The overall volatility can be reduced. And that is quite visible from this example here, that the overall standard deviation to mean may be higher. It is even 0.63 in one case, 0.44, 0.49, 0.36, right? But when we are doing the diversification for different portfolios, different zones over here, the overall standard deviation to mean value is very much lesser. So companies and banks do try diversification whenever they are to reduce the overall risk. So whenever we are to reduce the overall risk, we can do play along with the diversification, right? Further, now let's learn about the downside potential. Very important point to understand. Downside potential. See, in the case of normal volatility, we are talking about the favorable points also and the unfavorable points also. Like we drew the graph and I told you that the some points might be favorable and the some points might not be favorable, right? But in the case of the downside potential, we are trying to get along with the adverse side only, because the risk materializes only when they do deviate adversely, right? So when something is basically falling, let's say ROA is falling and that's not good for us, only then we can say na, that there is risk. If it is rising and if it's good for us, it's favorable to us, how can I be saying that it's basically bad or it's basically causing risk to us, right? So as to basically measure or quantify the risk, it is very much important that we must be focusing only on the adverse side, and downside potential is the one thing that does the same. And the biggest limitation for the volatility is that it captures both sides, whether it is upside or downside deviation, it captures the both. But downside potential captures only the downside only, right? So it is an adverse deviation only. So we can say that in case of the downside potential, the target variable is the adverse deviation. The target variable is a adverse deviation. But in the case of the downside potential, we are having the two major components with us. One, it is related to the potential losses. Now potential losses still can be calculated. Potential losses still may be calculated, but if you are to estimate the probability of occurrence, it is very much difficult to estimate, and you must be having proper modeling of the probability distribution if we are to calculate the probability of occurrence. It is very much important to have the same. Otherwise we won't be able to calculate the downside potential, right? So if you have to calculate the downside potential, two factors are to be calculated. One, it is the potential losses, which can be estimated. This can be estimated, but so as to deal with this one is difficult. You do require proper modeling of the probability distribution, that is to be done, right? That's a proper model that is to be done, right? So we can say downside potential is the most comprehensive measure of the risk, because it integrates both of the things, sensitivity, volatility, in the same thing, right? And which is the basic measure of the downside potential? It is the VAR, that is value at risk. Value at risk is there. Now what do you mean by value at risk? Now value at risk is available to you for a time horizon. It is available to you time horizon, and it also gives you probability of occurrence or confidence level, right? So let's say the case, if I'm going to invest rupees 6 lakh, if I'm going to invest rupees 6 lakh, and I do say that there is a 95% of the confidence limit, 95% of the chances over there that your VAR, that is a value at risk, is 6,386 only. That it is 6,386. It is 95% of the chances over the 10 days of the time horizon. Over the 10 days of time horizon, if I calculated the VAR and it is found to be 6,386, what does this indicate? This simply indicate that in normal conditions, I'm not talking about the abnormal conditions, right? Under the VAR, we are going to go for the normal conditions only. That under the normal conditions, the maximum loss that will be limited to rupees 6,386 over 10 days of the time horizon, 95% of the cases. That under 95% of the cases, your maximum loss would be limited to rupees 6,386 over the time horizon of 10 days. With 95% of the possibilities, only 5% chances are there that your maximum loss can exceed 6,386. This is what this is VAR. This is the value at risk, right? Further, we're going to consider the risk pricing. Risk pricing. Now see, definitely the risks are going to impact the bank earning or bank's transactions, and banks are to maintain the necessary capital. It is very much required. See, whenever the banks are working, and let's say case that the banks are have generated let's say 100 crores of the deposits, not generated, they are basically mobilized. Let's say the banks have mobilized 100 crores of the deposits. Does bank can be lending rupees 100 crore further to the public? Anyone, please reply yes or no. Can it be done? If the bank has mobilized 100 crore of the deposits, can bank be lending rupees 100 crore further? Is it possible? Answer is no. No, the bank cannot do so. Even if the bank has mobilized rupees 100 crore, bank still cannot be lending rupees 100 crore. Why? The banks are to maintain the CRR balances. This is a statutory obligation. The bank is to maintain the SLR, statutory liquidity ratio, cash reserve ratio, these are to be maintained, right? Let's say case CRR is 4%, SLR is 18%, 22% of the 100 crore is already gone, right? The bank can lend maximum 78 crore, right? And let's say case the bank lent rupees 50 crore out of it. The bank lent rupees 50 crore out of it, but still now, even for the standard assets, the bank is to make the provisions. The bank is to make the provision out of it. And more other than that, as per the Basel Committee of the Banking Supervision, BCBS, which gives the guidelines related to the Basel 3, the banks are to maintain the capital adequacy ratio. The banks are to maintain capital adequacy ratio, or we can say capital risk weight asset ratio. The banks are to maintain this ratio also, which is minimum of 11.5%. I'll be giving you the bifurcation for the same in the next chapter, right? The banks are to maintain such ratios. And if any debt, particularly if any debt is recognized as a bad loan, the banks are to maintain the higher provision also. So the bank cannot be lending the equal amount. So definitely there is a capital cost for the bank. There is going to be a capital cost to the bank which is to be maintained. What I'm trying to say, whenever we are to price the risk, we have to make sure that we are also to maintain the capital. That is very much required, right, as per the regulatory requirement. And the capital required is not without cost. You have to pay the cost for the same, because even if you're having 100 crore rupees, you're paying 6%, let's say average on 100 crore rupees, right? And other than that, definitely there is loss probability that the people to whom you have extended the loans, credit lines, they can default, right? There is definitely a very bright opportunity that you can be having a loss. There is a probability of loss, right? So that is also to be factored into price, right? That is also to be factored into price. That thing is also to be done, right? So risk pricing is implying so what it is implying, that we are to match the capital cost, we are to match the loss probabilities also. Okay, so this would be in addition to the actual cost. In actual cost of the transaction, the bank is to pay the salary, the bank is to pay the infrastructure, so is to maintain the infrastructure, and other relevant overhead expenses are there. That is also to be taken into account. Those risks are, or those expenses are also to be taken into account. So it's not only about the capital, it's not only about the loss probability, but it is other expenditure also which the bank is to incur, and for which the bank is to set aside the profits or the charges for it, right? So the prices should be taking into account what different factors: cost of deployable funds, operating expenses, loss probabilities, and capital charges. These four things must be kept in mind: cost of deployable funds, operating expenses, loss probabilities, capital charges. All of these are to be maintained. All of these to be maintained. If you are able to understand the chapter so far, the video so far, and if you're liking the particular content, please give this video a thumbs up and do share it with your friends and colleagues who are preparing for the CIB exam, right? I'm going to bring much more videos for you, much more content for you on daily basis. Make sure to like this video and share this video among your friends and colleagues who are preparing for CIB. Kindly do the needful. It will really be motivating me so as to bring much more content for you. Now, after that, it's related to risk monitoring and the control. Now, definitely, there must be an organizational structure. Like I told you that board of directors at the topmost level, then board level subcommittee is there, senior executive committee is there, right? And support group is there. So the bank must be having a comprehensive risk measurement approach, right? So that must be their comprehensive risk measurement approach must be there. The bank must be having the risk management policies, and those policies must be consistent with the business strategy. It should not be the case that your business strategy are somewhat different and your policies are somewhat different. Those must all be aligned in such a manner that you can make them work together, right? So the risk management policies must be consistent with the business strategies, with the capital strength, with the management expertise, with the risk appetite also, right? And definitely there must be prudential limits. There should be discretionary limits. Let's say officer scale 1 is given the limit that you can sanction a loan up to rupees 10 lakh. Officer scale 2 is given a limit that you can sanction the limits up to rupees 25 lakh, and so on, right? So the discretionary limits should be given. Risk taking functions must be defined particularly, right? So that should be the case. And monitoring is very much required. So if there is any divergence, let's say if there is any deviation from the planned performance, right, it should be checked. It should be checked, and it should be kept under the acceptable level. It should be kept under the acceptable level. Like in the case of the when you're going to invest into the market, you must have heard of the term stop loss limit. You know what is stop loss limit? That is basically kind of monitoring you do, right? Let's say case I bought a share at rupees 100, and I'm considering whenever someone purchases a share, they do consider the prices will rise, right? They never thought they like the prices will go down, right? So let's say case I'm thinking that the prices will go beyond rupees 120 or up to rupees 120, but the prices are now sloping down, right? Let's say case is it came down to rupees 90, but I've set a stop loss limit at rupees 72, right? So when the price will hit rupees 72, I'll be scaring of the transaction. I'll be selling my whole lot, right? So that I cannot be having further losses. I already basically absorbed losses of rupees 28 per share, and I don't want to absorb much more losses than rupees 28. So I have set a limit of rupees 72, that if it comes down to rupees 72, it will hit the stop loss limit and I'll be selling the whole lot, right? So this is how we can limit our losses. The monitoring is to be done. So if the bank management sees that there is any kind of deviation, the deviation must be under the acceptable limit, right? The last step, it's related to the risk management, risk mitigation. It's related to the risk mitigation. Now what do you mean by mitigation? The risk can never be made zero. If the risk is made zero, it means you're taking no opportunity, you're giving away the opportunity, and you can make no money out of it. Then it should be kept in your mind that if you are to make money, then you are to take some risk. Definitely you have to take some risk. Even in the case you are having FDR in the bank, you are having some risk, because the insurance is available to you by the DICGC up to rupees 5 lakh per account only, even not more than that. If something goes out of the way, right, even you won't be getting much more amount from the bank itself, right? So you are, either way you're taking a risk. The bank deposit is definitely safer, but it's not say like it's not totally zero risk, right? It's not the case. So the risk mitigation can be done, but it is always done at some cost. As I told you earlier also, whenever we are trying to mitigate some risk, we basically lose some of the opportunity also, right? We lose some of the profits also. Like I told you, I gave you the example, like you purchase the CDS, credit default swap. In that scenario, if something goes wrong, you're going to get the get the money, or get so as to get the insurance from the other person who is the protection seller, right? But you're paying a premium to that particular person. That's a cost to it, right? You're losing your upside potential also. That's the case related to the risk mitigation. Okay. Now, for the traditional credit risk mitigation, we are having like a different thing. Like you can be having a collateral. Previously, it was the case. You could be going for the third party guarantees, or credit derivatives can be used. Further, interest rate mitigation can be done by the way of interest rate swaps, by the way of forward rate agreement. We'll be learning them all. We'll be learning about them all in the coming chapters. So don't worry about it. Financial futures can be used. We can be using the FRAs, right? Forward rate agreements. We can be using the interest rate swaps. We can, interest rate swap is like where you do change the interest rates between, like if you are earning a fixed rate and you want to go for the floating rate, you can swap the interest rates. Basis swap is even available, where floating to floating rate can be exchanged. Let's say case person A is earning floating rate based on LIBOR, London interbank offer rate, and person B is earning interest rate benchmarked on MIBOR, right? And they want to swap their interest rates. That can be done. That can be done. They can be swapping their interest rates by the way of the IRS, that is the interest rate swaps, right? And this is trade-off. Risk mitigation aims to reduce the downside potential, but definitely it can reduce the upside potential too. It can reduce the upside potential too. That is a very much important point that you should be understanding. Is that clear? Okay, so risk mitigation can be done through diversification. I already gave an example. So if you do the diversification, the overall risk can be reduced. Overall risk can be reduced. Then further portfolio risk management can be done, like geographical diversification can be done, maturity diversification can be done, like all the assets are not maturing on the same dates. So you should be having the different assets which are maturing over the different time horizons. You can be having the sector diversification, like you're not just lending in the health sector, you're lending in the MSMEs, agriculture, education and other sectors, right? So the diversification can be there, counterparty diversification can be there, like you're not lending to only just one particular realm of the counterparties. You are basically lending to each and every other different parties, also individuals, corporates, HF and all, right? For the product diversification can be there. You're not just lending to the agriculture, or you're just not following one particular product over there. You are giving away the other products also. So these are the different diversification techniques which can be used, right? And these works better, so much better so far. So that was all about the chapter 1. I hope that you must have understood the concepts related to it. So if you have liked the video so far, give this video a thumbs up. Give this video a thumbs up. And now we are going to learn all about the chapter number 2, which is related to risk and banking business, which is related to the risk and the banking business. And this is very much important. So if we are talking about the banking business lines, we are having the 3 banking business lines. We are having the 3 banking business lines. One, it is related to the banking book, where all your assets, all your deposits are placed, which are going to be there for held till maturity basis. Second, it is related to trading portfolio, where you're going to actively position your assets, or we can say your positions, your holdings, and this is MTM basis, mark to market value basis. Now what is HTM, what is MTM, I'll make you understand very well, don't worry about it. And the third one, and it is related to the off balance sheet exposures, like your bank guarantees, letter of credits, the commitments on undertakings, right? So that is your off balance sheet exposures. So first one, we are going to learn about the banking book. Now, in case of banking book, you're having all the advances. Whatsoever your advances, borrowings, right? Those all will be under your banking book, which you're going to hold till the maturity. We are going to hold this all till maturity. Until the maturity, you will be having these things with you, right? And maturity mismatch can be leading to what risk? It can lead to liquidity risk. In the very first video, I gave you an example. You're having an asset that is a loan for a term of, let's say, 5 years, where 1 year moratorium was there, right? And you're having your liability of the same amount for 3 years only. Now, after 3 years, after the 3 years, you have to replace the net cash outflows. That was a funding risk which was available over there, right? And when your assets and liabilities having the mismatch before the maturities, or you can say if you're having the shortage of the liquidity, it will lead to what type of risk? It will lead to the liquidity risk. If you're having shortage of liquidity, it will lead to the liquidity risk, right? And if we talk about the interest rates, definitely those can change, those can alter, and ultimately they can be reducing your net interest income. Your net interest margin can be reduced. Let me give you an example. Let's say the case that you were paying a interest rate of 6%, 7% on your liability, and you were receiving an interest rate of 11% on your asset. What was your net interest income? It is 11 minus 7%, that is 4%. So you were earning 4% here, right? Previously. But now what happened? Let's say the benchmark for the asset reduced. Let's say it was based on the MCLR, and MCLR rate reduced. Now if the MCLR is reduced, now it is 9% only, right? Now what is your net interest income? It is now reduced just to 2%. Your spread which you were earning before 4%, now it is reduced to 2% only. So it is what type of risk? It is an interest rate risk. So you are to keep in your mind that in case of the banking book, we are dealing with mainly with the liquidity risk, we are dealing with the interest rate risk, and definitely let me tell you that you are giving away the advances. There is definitely a very bright chance that the people can default, right? So it can definitely be generating the credit risk out of it. If the people do default and the payments are not repaid back, definitely the risk is there, which is said to be the default risk or the credit risk. Further, whensoever the people are dealing, whensoever the systems are involved, the very obvious risk is there, that is operational risk. Operational risk is risk related, that the loss of probability is there due to the human failures, or let's say due to their omissions or commissions or internal frauds, or let's say deficiency of the information systems. Let's say systems are not working, connectivity is not there, due to which the loss was there. Let's say external calamity is there. Those all are related to the operational risk. So operational risk definitely can be there. And in case of the banking book, which accounting system is followed? The accrual basis of accounting is being followed. Very much important. Accrual basis of accounting. Now, what does this indicate? What do you mean by accrual basis of accounting? Let me just quote you an example. Let's take the case you gave an advance to person A of amounting rupees 1 crore, right? And the person is to pay the installments on quarterly basis, right? Let's say case March, June, September and December, the person is to pay the installments. Now on the 31st of the March, the installment which was to be paid by person is due, right? And the financial year end. Now the person has not paid to you that particular amount in cash. It means the amount was due but has not been paid so far. Getting this point? The amount was due but has not been paid by the person A so far. But as per the principle of the accrual basis of accounting, you can be accounting for this as your income because the particular installment is now due. The particular installment is now due. But this is not followed for the non-performing assets. For the non-performing asset, the cash basis accounting is followed. Kindly keep in your mind that for the non-performing assets, cash basis accounting is followed, that whenever you will be receiving the cash, only then you'll be accounting it as your revenue. But in case of general accounts, standard accounts, you do follow accrual basis of accounting, right? We do follow accrual basis of accounting. So that's about the banking book. So let me just give an idea again related to the banking book. All your deposits, all your borrowings are under the banking book, and these are on MTM basis, mark to market, sorry, HTM basis, that is held to maturity basis. And definitely there is a liquidity risk, there is interest rate risk, and default risk is there, operational risk is there. That's about the banking book. The second one, it's related to trading book. Like if you're trading individually, you are maintaining the position related to the equities, related to the different derivatives, let's say, or other things in the market, but you're not going to let's say hold those things for a very longer duration or till the maturity. You're not going to hold. Whenever there will be an opportunity so as to make the profit out of it, you will be selling them or you'll be scaling off the transaction, right? That is the case with the trading book. So whatsoever the trading book assets are there, those are the marketable assets. Those are the marketable assets that you can be trading those assets in the market. And further, those are not held till maturities. Those are MTM basis, mark to market value basis. It means whatsoever the value, current value that will be in there, that will be booked in your book, that will be booked in your portfolio, right? So it is mark to market basis. So I bought a script at rupees 100 and previously it was rupees 100. The next day it amounted to rupees 102. So rupees 2 will be credited to my portfolio. The next day it dropped to 95. So rupees 7 will be subtracted from my portfolio and so on, right? So this is basically MTM basis, that is mark to market basis accounting will be followed, right? And the difference between the market price and the book value will be taken to the profit and loss account, right? So it is comprising of the income securities, equities, foreign exchange, holdings, commodities, all are over there, right? It could be the case that you are having the market overseas, but definitely sometimes what happens that the liquidation is not there. See, liquidity is something different. Liquidity is like you're not having the money with you, but liquidation is related to when you want to sell particular asset, but you're not able to sell that particular asset at the reasonable price. That is a liquidation risk. It could be the asset liquidation risk when you're not able to let's say sell a particular asset in the market, or it could be a market liquidation risk when the overall market is down and there is no much more demand in the market, right? It can be both. And the most prominent risk that exists in the case of the trading book, it is a market risk. It is the market risk. Why market risk? Because definitely we are going to deal in the market, and the market prices can be going up and down, and an adverse impact can be there. So it is a market risk, which is definitely very much obvious. It is also said to be the price risk. The market risk is said to be the price risk. Okay, is that particular thing clear? And other than that, definitely if the counterparty